With Christmas approaching, you may be asking yourself, what wondrous gift in the form of an investment can you give yourself this year?
All right, how about some presents? I want to see some presents.
I know you're not looking for coal in your stocking, so let's take a closer look at some investment picks that will make it look like Santa knew exactly what you needed. I'm Jonathan, and we're talking about the best dividend stocks to buy right now in today's edition of Constant Cash Flow. I want to give a really quick shout out to Cajun Box 001 and Dax, two recent subscribers before we dive in. Thanks for subscribing, guys, and watching. Today, we're going to look at 3 dividend investments that I believe are solid picks to get a jump start on 2022. Each one has a starting dividend yield of 3.5% or better with solid growth and are great additions to any dividend portfolio. Make sure you hang around to the end because pick number 3 is going to be a total 180 and a complete surprise compared to the first 2 selections.
Nobody's going to see it coming.
Let's kick things off with a stock from the financial sector that has a great dividend track record and a promising outlook for the future, especially in light of the current inflation situation. We're looking at First of Long Island Corporation, ticker symbol FLIC. It's a regional bank founded in 1927 in Glen Head, New York, and focuses on business and consumer needs in Long Island and New York. Although it's not on many people's radar, and you won't see it blazing trails in most YouTube videos here, it merits a solid look, especially now. There are 2 quick things that I like about the bank itself. First, they've repurchased over 300,000 common shares this year for about $6.3 million. This boosts shareholder value. Second, the company recently raised its dividend by 5.1% to 20 cents quarterly. Based on the present share price of around $21, the stock yields just under 4%. That's a high yield for a regional bank, so you're paid to wait. This makes FLIC a very shareholder-friendly investment. Financial institutions in general are well positioned with the current inflation situation in the United States and the looming interest rate increases.
This has to mean something.
As long as consumer buying power remains high during inflation, they tend to profit, and to a large degree. FLIC is already a dividend champion, having paid a dividend for 25 consecutive years. It has a 5-year dividend growth rate of 7.35% and a payout ratio of 35% against free cash flow, which puts it right in the crosshairs of the stocks I like to invest in. Switching gears just a little, let's take a look at a company in the consumer staples sector that has strong ties to the healthcare sector. Walgreen Boots Alliance, ticker symbol WBA. I'm always looking for dividend growth prospects. Whenever I see a dividend aristocrat trading for an attractive valuation, I'm checking it out to see if there's long-term opportunity due to a short-term weakness. Walgreen Boots Alliance has been paying a growing dividend for the last 46 years and is in exactly that situation. WBA operates as a pharmacy-led health and beauty retail company. It operates through 2 segments, the United States and International. The United States segment sells prescription drugs and an assortment of retail products through its retail drugstores. The International segment sells prescription drugs and health and wellness and other consumer products through its pharmacy-led health and beauty retail stores and optical practices. Revenues have almost doubled in the last decade.
Thank you.
This mid-single digits annual growth rate is due to the combination of organic growth and M&A activity such as the Rite Aid acquisition in 2015. The company is expected to grow at low single digits in the medium term. With inflation above 6%, this could signal a decline in sales. As I mentioned before, Walgreens is a dividend aristocrat. The company's raised the dividend for 46 years in a row. However, the last raise was only 2% as the company is struggling to grow its EPS. The company's dividend, though, is extremely safe as the payout ratio is 33% versus free cash flow. Investors should expect raises of around 3% in the short term until Walgreens manages to grow EPS faster. The company's trading for an attractive valuation as the current PE ratio is 9.5. That means that the company is trading for less than 10 times its 2021 earnings. The company's 50% cheaper compared to its average evaluation in the last 2 decades. However, during these decades, the company has grown at more than double the pace it's growing at the moment. If the company manages to complete the turnaround that it's currently undergoing and find a path for growth, it may be extremely undervalued.
And it's a bargain.
In the end, Walgreens is a good company that's struggling to grow. The company's suffering from relatively slow revenues and EPS growth that's translated into slow dividend growth. On the other hand, the company's attractively valued, roughly half the average valuation that it's had over the past 20 years. While the company has a path for growth through its initiative to build integrated healthcare offerings using different channels to communicate with its clients, it also has to deal with significant risks. Investors should consider investing only if they have a long-term horizon and they can enjoy the 4% dividend as they wait for the shift to be completed. If you're looking for a little more immediate returns, our third choice can help in that regard. And I also have a video that talks about how to live off dividends faster. You can watch it by clicking on the link in the top right or clicking the link in the description after you finish watching. Now, let's totally shift gears for our third pick.
Okay, lay it on me.
On the other end of the spectrum from our individual stocks, we have CEFs, or closed-end funds. Closed-end funds are a type of investment company whose shares are traded in the open market like a stock or an ETF. Capital does not flow into or out of the funds when shareholders buy or sell shares. CEFs almost always trade at a price different from their share value. This is called the net asset value, or NAV. We're going to look at BlackRock Science and Technology Trust, ticker symbol BST. BST currently sports an attractive 5.8% dividend yield, and unlike some CEFs, which constantly trade at discounts to their daily NAV and below their inception to NAV, BST has a history of trading at a premium. Its inception NAV was $19.06 versus its current pricing at above $50, indicating long-term value gain for shareholders. BST has a 5.91% discount, which is a much deeper discount than its historical 1, 3, and 5-year average premiums of 1.5, 1.8, and 0.36%. BlackRock lists the investment objectives of providing income and total return through a combination of current income, current gains, and long-term capital appreciation. Under normal market conditions, it will invest at least 80% of its total assets in equity securities issued by U.S. and non-U.S. science and technology companies in any market capitalization range, selected for their rapid and sustainable growth potential from the development, advancement, and use of science and/or technology. BST pays monthly dividends, which is also a nice bonus to its stellar track record.
That sounds promising.
It uses covered calls to enhance its returns at a ratio of about 28%. BST's 109 holdings are distributed with 72% in large cap stocks, 6% in mid cap stocks, and just over 17% in small cap stocks. BST's average annual performance has been strong over the past 1, 3, and 5 years, ranging from 31 to 40%, while delivering just under 25% total return since its October 2014 inception. It offers great exposure to the tech sector, and I consider it a strong buy due to its historically high discount to the NAV. As you can see, there is value out there right now, and it's important in a volatile market to look for assets that you feel are secure for long-term growth. It's more important to understand the company or the holdings within an ETF or CEF than it is to make a judgment based on a hot stock or industry. These choices check all the boxes and would be great additions to any dividend portfolio. That wraps up our discussion on 3 top stock market investments to take a look at today. Thanks for watching. As always, please do your own research before making any investments to see if it's a good fit for you, your goals, and your personal risk tolerance. Keep an eye out for my next video coming out in just a few days that gives the top 5 reasons why you should invest in today's stock market. Let me know in the comments what you thought about today's video and what you'd like to see discussed in future videos. I want to make sure that I'm putting out content that you want to see, and I really value your input. I'd appreciate it if you could leave a like and subscribe to the channel if this video helped you in any way. On the right, you can find more great videos to help you on your journey to constant cash flow. I hope you enjoyed today's video. See you next time.